Hello and welcome back to our fourth lecture video dealing with chapter 13, which talks about capital budgeting decisions. In this video we're going to look at the internal rate of return method. So hopefully by the time we complete this video you should be able to evaluate the acceptability of an investment project using the internal rate of return method. So this is one of the methods that we identified all the way back in video 1, right? We said there's the payback method, there's the net present value method, which we've already covered, both of those. There's the internal rate of return method, which we're going to cover now. And the final one, which we're going to see in another video, is the simple rate of return method. And again, these are all ways of making capital budgeting decisions. So let's just jump right in. So before we can even begin to calculate the internal rate of return, we need to know what exactly is the internal rate of return. Well, this is the rate of return that's promised by an investment project over its useful life. We also call this the yield on a project. Okay, so when we're looking at the internal rate of return, what we're doing is we're trying to determine the discount rate that will result in a net present value of 0. Okay, so this is linked to the net present value method in a sense that this internal rate of return will give us a 0 net present value. So let's take a look at some of the techniques that we utilize or that we use with this internal rate of return. So again, this technique works very well if a project's cash flows are identical every year, right? We've already talked about this when we looked at the net present value method. We said that, hey, and especially with the payback method, hey, you know what? It's pretty easy to calculate or to make a capital budgeting decision if all the future cash flows are identical, right? It's not always the case though. So in the real world we have a lot of ambiguity and a lot of uncertainty about the future. So what do we do then if the cash flows are not identical from year to year? Well, in that case we have to use pretty much a trial and error process, right, to determine what is the internal rate of return. So we have some general guidelines here when we're using the internal rate of return. Kind of rules of thumb, so to speak, right? Well, what are they? Well, if the internal rate of return is equal to or greater than the minimum required rate of return, we say, hey, this project's acceptable. If it's less than the required rate of return, then the project is obviously going to be rejected. So keep in mind here that we're using that hurdle rate, right? And we said that normally companies utilize their cost of capital as that hurdle rate. Okay, so let's look at a quick example of the internal rate of return. How do we use this? So let's assume the facts that we have here about Decker Company, right? They can purchase a new machine at a cost of $104,320, and if they do this they will actually save 20 grand per year in operating costs. Okay, sounds good. The machine has a useful life of 10 years. So the thing to notice here is that since the cash flows are going to be the same every year, that $20,000, we can use the simple equation that we see here on the board, right? Investment required annual rate, or investment required, or um, initial investment cost divided by the annual net cash flow, right? This looks familiar, does it not? It should, because we saw this when we looked at the payback method. Now, the answer that we get, okay, is what we use to compute the appropriate present value factor of 5.216. So by taking the investment required divided by those annual net cash flows, we get a present value factor. This is the present value factor for the internal rate of return, which is 5.216. So then what do? Well, we have to utilize our present value of an annuity of a dollar table. And if we find period 10 and we scroll all the way over to the right to find our present value factor of 5.216, we scroll up, or we flow up, and we see 14%. Okay, so that's the internal rate of return. Now, should Decker accept this? Well, yeah, they really should, right? Because if Decker's minimum required rate of return is equal to or greater than 14%, then the machine should be purchased. Okay, they didn't tell us exactly what their hurdle rate was, or their required internal rate of return, but if it's 14, we're going to accept. If our required or minimum required rate of return is less than 14, we're still going to accept. Okay, so let's do a quick check here real quick. We have the expected annual net cash inflow from a project. It's $22,000 over the next 5 years. So right there, it tells us we have even cash flow, right? We have the same net cash inflow year after year after year for 5 years. The required investment now in the project is $79,310. What is the internal rate of return? Well, we would have to divide the $73,310 by our annual net cash inflows of $22,000. We get a present value factor. We have to then go to the present value of an annuity table of $1, and we find out, based on 5 years, where that factor falls and what percentage that is. So we see that it's 12%. How did we get that? Well, again, when we calculated the present value factor, we got 3.605. That's the present value factor for the annuity over 5 years. We had to then determine what that interest rate was by looking at the chart, and we got 12%. So not too bad. Now, how do we compare the net present value and the internal rate of return? Well, it's not I'm going to put this. Here we're talking about which one's easier to use, right? Is it the net present value or is it the internal rate of return? Well, it all depends, right? A lot of times we see that the net present value might not always be the most simple to use. So what we have to then stop and recognize is, well, what benefits or what are the advantages of using net present value over the internal rate of return, right? So we have basically two important advantages of the NPV method over the IRR method, okay? First, the net present value method, again, often it is simpler to use, okay? Second, the internal rate of return method makes a questionable assumption, right? What's that mean? Well, it's a questionable assumption that cash inflows can be reinvested at that internal rate of return. So that's not always the case, right? Interest rates are going to fluctuate. So we might not be able to reinvest those cash flows at that internal rate of return, right? So what happens next? Well, we have to look at that discount rate that we have, and we have to look at that internal rate of return that we have. So if the internal rate of return is high, well, then the assumption might not be realistic, right? If we use a more realistic assumption that cash flows can be reinvested at that discount rate, then the underlying assumption of the net present value holds true. That proves the net present value method. Okay, so there are two advantages to using NPV over IRR. Number one, it's easier to use. The IRR, well, depends, right? We saw that, if we have uneven cash flows, well, it's basically just kind of trial and error kind of a thing to figure out what the IRR is. So again, when we're comparing the two, NPV looks more attractive to us because of those two benefits, right? So if we take the net present value method, we can actually expand on it. Okay, so what we're going to do now is expand on this NPV method to include two alternatives, right? The first alternative, we're going to analyze the alternatives using the total cash approach. Okay, what do I mean by total cash approach? Well, what happens here is all cash inflows as well as all cash outflows will be included in the solution under each alternative. So no effort is going to be made to isolate those cash flows that are related to the decision and those that are irrelevant. Okay. Second, when it comes to the total cash approach, the NPV is going to be computed for each alternative. Okay, so let's take a look at an example of expanding this. Okay, so let's assume that we have White Company. They have two alternatives. We can either remodel an old car wash, or we can remove the old car wash and replace it with a new one. So those are our two decisions, right? Some important things we need to kind of recognize. First is the company uses a discount rate of 10%. Then they tell us that the net annual cash inflows are $60,000 for the new car wash and $45,000 for the old car wash. Now, in addition to all that, we need to assume that the information here that we see is shown as it relates to the installation of a new car wash. So this is the new car wash. It's going to cost us 30 grand or 300,000. Has a productive life of 10 years. There's going to be a salvage value of 7,000 at the end of those 10 years. At the end of year 6, we need to replace the brushes. Okay, we're going to replace those brushes. That's going to cost us $50,000. And then finally, the old equipment, there's actually a salvage value for that. If we sell that old equipment, we're going to get $40,000. So not too bad. So let's look at what we have here. So we're using the total cost approach. We're using the initial investment of $30,000 or $300,000, excuse me, which is going to happen now. We're going to have the replacement brushes in 6 years from now. That's the negative $50,000. Then we're going to have the annual net cash inflows. We're going to have the salvage value of the old equipment that's going to happen now. And then we're going to have a salvage of the new equipment that hopefully is going to happen 10 years from now. When we add all that up, we see that if we install the new car wash, the investment will actually yield a higher rate of return than what the discount is, right? We know that because we see that the net present value is positive by $83,202. So what we're saying here is that this investment is going to not only give us a positive NPV, but it's also going to provide us with more of a return than that discount rate that we're using. So the rate of return on this project, installing the new car wash, is higher than 10%. Now, let's look at the other scenario, or the second scenario, or the second alternative. What if we just decide to remodel what we have? What's that going to look like? Well, if we choose to remodel this existing washer that we have, it's going to cost us $175,000. The replacement costs for the brushes at the end of 6 years, it's going to be 80 grand. Well, very simple. We take all our cash flows, figure out when they occur, and then we go ahead and figure out what our net present value is. So we can see that based on remodeling the old car wash, our net present value would be $56,405. Okay? What does all this mean? Well, what we got to do is kind of look at the net present values, or the present values, of each scenario, meaning we invest in a new car wash or remodel the existing washer that we have. Since both of these projects yield a positive net return, we can see that because both numbers under each scenario is positive. Okay? However, the net present value of the new washer alternative is $26,797 higher than the remodeling alternative. How did you figure that out? Well, I took the present value of each alternative and I subtracted them, right? The investment in the new car wash, $80,000 or $83,000, minus the remodel, the existing wash, $56,000. That's a difference of $26,000. So because my invest in new washer has a higher present value, obviously that's going to be the better choice. That's pretty much it when it comes to the total cost approach. Basically what we're saying is we're still using the net present value method, but we're applying it to two alternatives, and then we're looking and saying, okay, based on these two alternatives, which present value looks better? And that's how we make our decisions. So that's it for this video dealing with internal rate of return and net present value, or total cost approach rather. Real quick, I just kind of want to reiterate a few things that are rather important. When we're looking for the IRR, or the internal rate of return method, we're using that simple equation, and this works very well as long as the annual cash flows are the same from year to year to year. If they're not, there we go. If they're not, we have to use that trial and error process, okay, to find out what that internal rate of return is. Remember, at the end of the day, the internal rate of return process is trying to find the discount rate that makes our net present value equal to zero, right? Because remember, we said that if the net present value is zero, that means that the discount rate is equal to the return on that investment. Okay, so when we come back, we're going to look at least cost decisions, and we're going to talk a little bit about dealing with revenues that are not directly involved in how we choose between alternatives. So actually, no, you know what, we still got some time. Let's do that now. Let's talk about that now, because that really coincides with total cost approach. Okay, so when we're deciding where revenues are not directly involved, what do? Well, we should always choose the alternative that obviously has the least total cost from the present value perspective. What in the world does that mean? Well, let's look at an example. So let's assume that we have a home furniture company, and we're going to analyze this decision of overhaul an old truck now or purchase a new one. And we're going to analyze this decision based on that total cost approach. So we have two alternatives: overhaul the old truck, buy a new one. And we need to assume here that they're going to do one or the other. Okay, home furniture company is either going to overhaul an old truck or they're going to purchase a new one. Remember, we have a discount rate. It's very important. We need to know that discount rate. It's 10%. So here's the information pertaining to both the old truck and the new truck, right? We have the old truck. It's going to cost us $4,500 to overhaul it. We have annual operating cost of 10 grand. Salvage value in 5 years is going to be $250, but if we get rid of it now, salvage value is $9,000. If we buy a new truck, well, it's going to cost us $21,000. We're going to have annual operating costs of $6,000, and the salvage value in 5 years for this new truck is going to be $3,000. Now, remember, we need to calculate, or we need to look at the net present value method from a total cost perspective. Okay, so let's look at it from this point of view. For us to buy a new truck, the net present value is $32,883. The net present value for us to overhaul the truck is $42,255. So right now we have a decision where we're gonna buy a truck or overhaul a truck. There's going to be future costs, and down the line there's going to be a future income, cash inflow, right? So both of these scenarios are in the negative, right? Both numbers are negative. Why? Because there's no revenue involved here, right? I mean, other than the salvage value, but that's not revenue. That's just more of an cash inflow later on down the road. Okay, so here, this is a prime example of the least cost decision, right? Which one should we do? Should we buy a new truck, or should we keep the old one and overhaul it? Well, based on the least cost decision, we should probably buy a new truck, right? Because it's going to in the long run, it's going to cost us less to buy a new truck than it is to overhaul and keep using the one that we have. By how much? Well, we see that the difference is $9,372. So the net present value in favor of purchasing a new truck is $9,372. Again, we have no revenue here that we're working with. It's all net present value from just from a cost perspective. Okay, so again, you're always going to want to choose, at the end of the day, the one that costs the least in the long run. Okay, when we come back, now we're going to stop and come back to another video, I promise. In our next video, we're going to look at an investment project that has uncertain cash flows. Okay, so we'll talk about that a little bit. So tune back in for our next video.